Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 7:08 a.m. Central Time, and I'm recording this in preparation for the market day of October the 15th, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and dive into our morning report. At the time of this cut, markets are up, and indeed the S&P's up about 0.6%. Russell's up about 0.75%, as is the NASDAQ. And then you have the Dow up a little less than 0.5%. Going the other way, you have crude oil down over 1%, euro down about 0.4%, bonds essentially scratched, just down marginally, and then gold up almost 0.5%. China up big, up over 2%. Hong Kong also up 2%. Japan up over 1%. Germany about 1.6%, United Kingdom at 1%. So pretty big action all the way around the clock, as it were. In terms of macroeconomic reports for today, you have unemployment claims, the weekly variety, core CPI, Empire State Manufacturing, and Philly Fed Manufacturing. Later today, you also have FOMC member Dudley speaking. And then a little bit of a twist, crude oil inventories is today. That's due to the holiday, Columbus Day holiday on Monday. Natural gas storage is also reported today. In terms of tomorrow, you have some industrial production, capacity utilization, and the University of Michigan Consumer Sentiment Report, and then the JOLTS report. So actually a number of things tomorrow. In terms of our current volatility conditions, short-term VIX up a little bit, 16.90. Skew still elevated, 135.8. So that's about a 10% probability of a 2 standard deviation move in the next 30 days. IV percentiles, though, very low. All basically in the lower quartile, 23, 26, 24, 24. You did have standard deviation moves put in yesterday by the Russell and the Dow. So a little bit more of a pop yesterday, but not enough to really kind of take things at any kind of significant elevated areas. In terms of the regular daily report, we did have some more changes for today. We think we're in phase 3. Bull flags is kind of the primary pattern that you're looking for. IBD status remains confirmed uptrend. Accumulation distribution on the S&P still scored as a B-. NASDAQ much more structurally poor as an E. GMI index flipped, and we've seen this with IBD during 2015. It's on the 9th occurrence of confirmed uptrend this year, and some of those have failed very, very quickly, and none have actually had follow through in this year. GMI index went to a buy signal on the 12th, and here 2 days later it flips back to a sell signal. So just tells you a lot about the kind of market conditions that we've been seeing and how these mechanical signals, which are normally very, very stable and do not flip-flop back and forth like they've been in this year. This author in GMI index also still in cash and remained in cash through that buy signal. So in a subjective assessment of the system, he stayed in cash, so that should tell you something as well. Primary market condition, as dictated by the relationship of key moving average lines, is still strong bear. Decision points, stock charts, you still see short term, yes, green arrows, but intermediate and long term, mostly with down arrows. Intermediate term market posture, still very bullish posture, but short term sentiment has weakened enough to possibly signal a posture change coming. In terms of position sizing opinions, you do have on the investor opinion exposure up to 100%, but that's a mechanical signal. We've counseled perhaps a more cautious approach. The active trader opinion also comes in as 75%. Intermediate term market posture, still very bullish. S&P 91.5, Dow 93.5, both of those in very good shape. But look at the new signals here. NASDAQ and Russell both flipped to bearish signals yesterday. So not terribly helpful there. Indeed, if you take the consensus of all this that we have, you know, you'd have to say that your portfolio investor posture is still in transition, and we have yet to determine whether this is a consolidation pattern that will continue to the upside, or if this is just a big complex bear flag and we're going to break down and make all-time new lows on this intermediate term pattern. Hedge warning status remains threshold level 1. There are elevated conditions. We call this the yellow light. Be cautious. You can take some positions to the bullish side, and I have taken bullish positions to the bullish side in the last week or so. But at the same time, it's not an all-in and load up the bucket, as it were, because this situation could deteriorate at any time. Indeed, in the volatility-based metrics, we've had a lot of flip-flopping here of late as well. We had these first two as warning signs a day ago. Those both ebbed off actually yesterday. What we do still have is VIX futures up over 18. That's a warning sign. You did have a new distribution day on the S&P and the NASDAQ yesterday, so in relatively short order we were starting to build this count again. NASDAQ's at a 3 already. If it goes to 5, that will be a warning status. You have that skew with an elevated probability of a standard deviation move, so that's a minor warning as well. And in terms of new highs, new lows yesterday, fairly benign, nothing really to note on either side there. In terms of the intermarket risk aversion indicators, they are all, we're calling this all 5 risk on right now. Now 2 of these were literally right on the crossover and not terribly angled. So we're calling these all 5 risk on, but they could easily flip back over if we have some weakness come back into the market. So it's that kind of market. When you have transition and consolidation and choppy sideways range bound markets, an awful lot of these signals will be very weak signals at best. In terms of special opinions, no new adjustments to these opinions at this point. Option income strategies, VIX is just outside the acceptable window for novice traders. More aggressive traders will certainly welcome the higher premiums that are obtainable at this point. You just got to consider position size and the potential for higher than normal delta and vega moves given the current skew level. In terms of cover call and put selling, these conditions are cautiously bullish. Be defensive. Use a 1-for-1 ratio of in the money and out of the money strikes, also a 1-to-1 ratio of higher beta and lower beta positions. Consider legging into those positions, and that may be the really smart way to do this. Sell that put, allow it to be assigned, and then having acquired that stock at a discount, then do your covered call. That would be a more defensive posture to take in. But if you've got some positions that you really like the chart setups, you can go ahead under these conditions, and it would be acceptable to go ahead and set up new positions. Just kind of consider, how you structure it and how you, do the mix, as it were. Put selling, consider defined risk positions, use those spreads, and then consider even as aggressive traders perhaps scaling into those full positions. Sector specific, a lot more red here today. You see how retail, of course, led the way down yesterday with the awful news from Walmart. And frankly, if you look at the chart there, this should not have been surprising. If you were an owner of Walmart, you've been under the cloud. You've been in a bear trend ever since the February release of their announcement that they were going to increase wages. And while the politicians and others, and we won't get into a debate as to what is appropriate about wage and employment standards and so forth. But still, you got to recognize that if you're an investor, these kinds of moves have implications, and it's not just the wages that increase, but the cost to Walmart for those Social Security taxes that go along with more wages, 401k matches. I mean, there's just all kinds of implications to this. They've announced a buyback, trying to blunt some of this effort. Obviously, was not meaningful to the investors yesterday. And this is no longer the #1 retailer in the world. With this drop in capitalization, Amazon is now the #1 retailer in the world. I suppose you could still say Walmart's the #1 bricks and mortar retailer, but they are not the largest retailer anymore. Amazon has now taken over that slot. And you think about it, I mean, shortly before that announcement about wages, they were at a 52-week high, almost $91, and here we are at $60 at this point. That's a 30% drop in value in a large cap. And it wasn't all yesterday. Even before yesterday, they had dropped 20% in value in a relatively short period of time. So this is a full-out bear market on this individual company. And this kind of a breakdown, this is what happens when you have a bear market. And bad news can just accelerate that. And good news doesn't get often rewarded. So I wanted to go ahead and throw that chart up there and kind of show that as an example. Because we can see the same things in broad markets, that good news in bear markets is hardly rewarded, and bad news is seen with aggressive movement and can really move the other way. Of course, the opposite is true in bull markets. Bad news is hardly noticed, and good news, just accelerates the process. So you've got to understand where you are in your structure when you hear reports like that, and then the expectation of what's likely to happen. One thing on the SPX, I think I mentioned yesterday that we had dropped back to a 23 fib. Actually, that was premature. Today, with this candle, we are back to the 23 fib. We're also noticed back here to the what was resistance, now turned support. A little bit of an undercut. Of course, this was a little bit of an area. It wasn't a fine line, but overnight action, of course, has us as bouncing off this. So we thought that we might get a minor retracement. If that's as minor as it gets, that would not be terribly surprising. And if we get a bounce, the question will be is what will happen next? Will we get through this area of resistance, or will we break down through this area of support? We've got two kind of lines in the sand that are in relatively close proximity, and obviously the action's not going to stay between 2020 and 1985 for long. That's a relatively narrow range, and certainly a range that can be traversed in one day. So we'll see what gives here, but basically whichever way this breaks out of this pattern will be our short-term indication for bias. Now, if it breaks out to the upper side, we've got our next area of resistance as the bottom of the prior range. Again, relatively close, and as you had a bearish breakdown, and as you come back up, you have to crawl through all these areas of resistance now. And so to be able to continue this move, we've essentially achieved the first level. We now need to break through the second level. Have not broken through the second level yet on the S&P. But if we do, we then have the third level that then needs to be broken. So we'll continue to be fighting through these levels if the bulls are to maintain their momentum. On the downside, of course, it could easily break and fall back down. And it could come down as low as this fib area here between the 50 and the 618. That would be a natural place to find support if the bulls are going to ultimately retain their bias. Russell, of course, has been decidedly weaker, though in the overnight seems to be doing the strongest. So this has kind of been an interesting pattern as well. NASDAQ, of course, big time earnings will be moving this market around. We've got Netflix earnings, and from what I've picked up so far, it looks to be a pretty big disappointment on Netflix. And then let's see, and the Dow, of course, had been relatively the strongest, and we'll see how this responds to this most recent action. Cash today will be, when the cash market opens, will be pretty interesting. So let's see here, what else do we have? I think that may be about it. In terms of sector-specific percent change, you do see energy and materials benefited yesterday. There was a move in the dollar, and as a result of that, the these areas did well. But then also on the flip side, you see an awful lot of red, and especially in this consumer area. This retail environment, wasn't just Walmart. When Walmart went down, wage has implications to their competitors. So Target and Costco and others, to various degrees, were also impacted by that move. I think that's probably enough for today. First of all, if you find this helpful to your trading, we greatly appreciate you showing that acknowledgement by retweeting us to your Twitter followers, to your stock Twitch followers, like us on YouTube, subscribe to the YouTube channel. Of course, direct comments can be sent to support@falconglobaltraders.com. Disclaimers as always. Hit the pause button if you need more time to review these. And we'll see you back here tomorrow morning before the market opens with the Falcon Global Market Preview. Good trading.